Welcome to this course on quantitative investment management. This is being offered to you by IIT Roorkee under the NPTEL program of the Government of India. When we talk about investment, we essentially talk about the postponing of consumption. For example, when you invest in a fixed deposit, what you are doing is you are putting in your money into the bank as of today, sacrificing consumption as of today, and you will get back the money at a later date on the date of maturity of the deposit, and then you can consume that money for whatever purpose you desire. In other words, there is a postponement of consumption from today to the date of the maturity of the fixed deposit. This is a basic property, a basic feature of investments. Now, because the future is intrinsically uncertain and you are getting the money at a future date, it means that there would be a certain amount of uncertainty, whatever that may be, but there would definitely be a certain amount of uncertainty attached to the realization of your investment at the future date. This brings us to the two parameters that are cardinal to the valuation of investment, to the assessment of investments. Number 1, the expected return, and number 2, the risk attached with the realization of that expected return. So, we always talk about a two-dimensional evaluation of investments in risk return space. Now, based upon the risk return characteristics of various securities, we can classify the securities into fixed income securities or debt securities and equities, which are essentially ownerships, and then we have a new class of securities called derivatives, which has a feature of the price process and the payoffs relying on the price process or the payoff of an underlying asset. In other words, the price process is a function of the price process of an underlying asset. We shall be talking about this classification in detail. We shall follow it up by the valuation, the intrinsic valuation of various types of securities, be it bonds with special features as well, like embedded options. Then we shall be talking about the intrinsic valuation of derivatives as well. The next important point that I would be covering here is the measure of risk in the context of various types of securities, measure of fixed income portfolio risk, measure of equity risk, and how kind of risk can be managed. These are the salient features of the contents of this particular program, this particular course. The course has relevance for those who are pursuing the CFA program of the United States, those who are pursuing MBA program, students working through to the chartered accountancy degree, cost accountancy, company secretaryship, and the students of commerce at the undergraduate and the graduate level. It is recognized, or it will be recognized across the spectrum of financial services industry, which includes brokers, which includes trading houses, merchant bankers, portfolio managers, investment bankers, and regulatory authorities as well. The course structure is traditional and in line with the NPTEL protocol. It is a 12-week course. We shall have assignments at the end of each week, and we shall also have a final exam at the culmination of the course. I look forward to welcoming you at this course commencement. Thank you.